What if I told you the next global financial crisis won't begin with a stock market crash, or a housing bubble, or even a banking panic? What if it begins quietly, inside central bank vaults, trade agreements, and digital payment systems most people have never heard of? No emergency broadcasts, no dramatic collapse overnight, just countries slowly changing the rules of money. Welcome to its financial history too. For decades, the US dollar has been the foundation of the global economy. It settles international trade, prices oil, backs reserves, and acts as the ultimate safe haven during crises. When markets panic, investors run toward the dollar, not away from it. But what if that dominance is no longer untouchable? What if the world's second largest economy has been preparing patiently and strategically for a future where the dollar is no longer at the center of everything? This isn't about tariffs. It isn't about headlines. It isn't even about politics in the usual sense. It's about power, financial power, and how it shifts. To understand what's happening today, you have to go back to the foundation of the modern financial system. In 1944, as World War II was nearing its end, representatives from 44 countries met in Bretton Woods. Their goal was simple: prevent another Great Depression and create a stable monetary order. The solution they agreed on placed the US dollar at the center. The dollar was tied to gold. Other currencies were tied to the dollar. America, holding the majority of the world's gold and industrial capacity, became the anchor of global finance. Then came 1971. Facing mounting deficits and pressure on gold reserves, President Richard Nixon ended the dollar's convertibility into gold. The system changed overnight. The dollar was no longer backed by gold, was backed by trust. That decision could have weakened it permanently. Instead, something unexpected happened. The U.S. secured agreements with major oil-producing nations to price oil exclusively in dollars. Because every country needs energy, every country now needed dollars. Oil demand created dollar demand. Dollar demand created financial dominance. The petrodollar system gave the United States a unique advantage. It could issue the world's reserve currency. It could finance deficits more easily than any other nation. It could borrow at lower costs. It could expand liquidity during crises. For decades, no serious challenger emerged. Then China rose. In the 1980s and 1990s, China integrated into global trade and became the world's manufacturing hub. It exported goods at massive scale, generating enormous trade surpluses. And what did China do with those surpluses? It bought U.S. Treasury bonds. By the 2010s, China held over $1 trillion in U.S. debt. At first glance, this looked like cooperation, mutual benefit. The U.S. consumed, China produced. The U.S. issued debt, China financed it. But beneath that cooperation was something more strategic. By participating deeply in the dollar system, China learned how it worked. It saw how global liquidity flowed. It saw how international payments cleared. It saw how access to dollar settlement systems could determine whether a nation could trade at all. And then it saw something else. The United States began using its currency as a geopolitical tool. When countries like Iran were sanctioned, they were cut off from dollar clearing systems. Later, when Russia faced sanctions, a portion of its foreign reserves was frozen. Banks were restricted from the global payment network. The message was unmistakable. Access to the dollar system could be revoked. For China, this wasn't theoretical. It was a warning. If geopolitical tensions escalated in the future, could the same mechanism be used against them? That possibility triggered a quiet shift. China began gradually reducing its holdings of U.S. treasuries. It increased gold reserves. It expanded bilateral trade agreements settled in yuan. It built its own cross-border payment system as an alternative to SWIFT. It accelerated development of the digital yuan. This wasn't a sudden rebellion. It was a hedge. Cause and effect began unfolding. The more the dollar was used as leverage, the more other nations considered diversifying away from it, not necessarily abandoning it, but reducing dependence. At the same time, global central banks began purchasing gold at record levels. Gold doesn't rely on any government's promise. It cannot be frozen by foreign authorities. It exists outside the digital financial infrastructure. Individually, these shifts seem small. Collectively, they suggest something deeper: the gradual fragmentation of a once unified system. Here's where the real risk emerges. The United States runs persistent trade deficits. It imports more than it
Payment quarter to
exports.
Singapore is clear.
This has been
Steam with
sustainable
volumetrics
because the
are climbing,
world
up in
recycles
Tokyo and
dollars
Seoul
back
are
into U.S. financial
Payment quarter to
assets,
Singapore is
especially
clear.
government
Steam with
bonds.
Volumetrics
That
are
recycling
climbing,
keeps
up in
borrowing
Tokyo and Seoul
costs
are up.
relatively low. But if
Payment
global
quarter to
demand for
Singapore is
dollar
clear.
assets
Proceeding with
declines
settlement. Volumetrics are
meaningfully,
climbing,
the
hubs in
equation
Tokyo and
changes.